If you go online right now and, search for mortgage brokers or major lenders, you will find just a sea of one-star reviews.
Oh, yeah. It's mostly just sheer panic out there.
Exactly. I mean, the modern financial transaction is just largely built on friction. You upload your tax returns into some anonymous portal, you wait weeks for a response, and
you just sort of pray the algorithm doesn't spit out a rejection letter.
right. It is an inherently stressful industry. But today, for this deep dive, we're looking at a complete anomaly.
A total outlier, yeah.
We're examining a financial professional who has somehow achieved universal, glowing praise in an environment where, honestly, people usually only go to the internet to complain.
Welcome to today's deep dive.
It's just a phenomenal case study in consumer trust, because when people are dealing with their life savings, housing stress and volatile markets.
Which is everyone right now.
Right. Maintaining a perfect reputation through all of that requires a lot more than just a friendly demeanor. So true. So we are digging into the digital footprint of Timothy Joe. He's the owner of Village Mortgage based out of Glendora, California.
Yep.
And our sources for this analysis are his official company website and his highly detailed Yelp profile, which currently boasts a flawless 5.0 rating across 114 reviews.
Which is wild.
Yeah.
For anyone who understands how review platforms work, maintaining 5 stars over 100+ reviews in the real estate space is, frankly, a statistical anomaly.
Yeah, people don't usually rave about getting a mortgage.
Exactly. I mean, most people will leave a 5-star review for a restaurant if the fries were hot.
Right.
But a mortgage requires a client to surrender months of bank statements, undergo invasive credit checks, and sign hundreds of pages of legal disclosures.
It's exhausting.
It really is. So to have over 100 people proactively go online to rave about that process, it signals a fundamental difference in how the machinery of this business is actually operating.
And that is our mission today for you, the listener. Understanding why this specific operation is so highly rated will completely reframe how you view your own financial relationships. Okay, let's unpack this.
Let's do it.
Before we get into the customer service aspect, we really have to look at the structural foundation. We all know the basic definition of what a mortgage broker is, sure, but the logistical execution here is what stands out.
It's completely different.
Yeah. According to his Yelp profile, Timothy operates as both a direct lender and a mortgage broker, holding an MLS license 6318030. But the critical piece of data is that he is contracted with 100 different banks, credit unions, and lenders.
Right. And the NMLS number, that's the Nationwide Multi-State Licensing System Identifier, that's just standard.
Sure.
It's the registry that ensures a broker is compliant and tracked. But the 100 lending relationships, that is where the structural advantage actually lies.
It's a massive network.
It is. And on his page, he explicitly points out the contrast with merger retail banks, using Chase as a specific example.
Right, he calls that out directly.
Yeah. When a consumer walks into a retail branch of a major institution, that bank only offers its proprietary portfolio of loan products. It's a completely closed ecosystem.
They only sell what they have on the shelf.
Exactly. If their current rate on, say, a 30-year fixed loan is higher than the market average that day, the consumer just has to absorb that cost or leave.
I mean, to put a different lens on it, going to a retail bank is like calling just a single airline to book a flight.
That's a great way to look at it.
You only see their schedule, their specific routes, and whatever prices they decide to charge. What Timothy is doing operates more like a massive, hyper-connected aggregator.
Right.
But instead of just showing you the flights, he's actively taking your single loan application and routing it through wholesale channels to see which of those 100 institutions will actually offer the most aggressive pricing to win your debt.
What's fascinating here is the mechanism behind those wholesale channels. Lenders actually offer lower interest rates to brokers than they do to the general public walking into a retail branch.
Wait, really? The general public gets a worse rate?
Yeah, and the reason is overhead. Think about it. A retail bank has to pay for the building, the tellers, the massive marketing campaigns.
All those commercials.
Exactly.
Yeah.
But when a broker brings a fully packaged, ready-to-underwrite loan directly to a lender, the lender saves on all that acquisition and processing cost.
Oh, that makes sense.
And they pass that savings on in the form of a better rate. So by maintaining 100 of these wholesale relationships, the broker is structurally bypassing the retail markup for the consumer.
But maintaining 100 active lender relationships has to be a logistical beast. I mean, having that vast network is only a theoretical advantage if you can actually execute on it.
Execution is everything.
Which leads us to a detail on his Yelp page under the hours of operation. Village Mortgage is listed as open 24 hours.
Yeah.
Every single day, Monday through Sunday.
Just jumps right off the screen.
And I really have to push back on this because we all know that extreme hustle culture is, well, it's a very fast track to severe burnout.
Oh, without a doubt.
In an industry that requires meticulous attention to detail, how does a single professional maintain a 247 schedule without eventually making some catastrophic math error on a $500,000 loan? Like, is listing 24 hours an exaggeration, or is it actually sustainable?
It is a totally valid critique. Sleep deprivation and complex financial underwriting do not historically mix well.
Not at all.
However, the reviews suggest this isn't about him just sitting at a desk doing math at 3 a.m. every single night. It's about a radical, strategic availability designed to capture market shifts.
Okay, so how does that look in practice?
Let's look at a specific review from a client named Peter L. So Peter details this scenario where he was in a super stressful situation and decided to call Timothy at 10:35 p.m. on a Thursday.
Calling a financial professional at 10:35 p.m. on a Thursday is wild. I mean, most automated phone systems lock you out at 5:00 p.m. sharp.
Right, and Peter actually wrote that he was terrified of being reprimanded for calling so late.
I would be too.
But Timothy answered the phone, greeted him warmly, and casually mentioned that 11 p.m. calls are actually very common for his workflow.
That's dedication.
It is, but the underlying reason for this late-night accessibility is the volatility of the bond market.
Let's break that down, actually, because I think a lot of people just assume mortgage rates are set like once a week by a committee in a boardroom somewhere.
Far from it. Mortgage rates are tied directly to mortgage-backed securities, which are traded on the open market just like regular stocks.
Oh, wow.
Yeah, so throughout the trading day, as economic reports come out or, geopolitical events happen, the pricing on those securities fluctuates. Sometimes a lender will issue a midday or late day price improvement.
Interesting.
So if a broker is strictly working 9 to 5 and a rate dips at 4:45 p.m., by the time they log back in at 9 a.m. the next morning, the market may have completely shifted and that lower rate is just gone.
So the 24/7 availability isn't just to be polite or do the hustle culture thing. It's a mechanism to literally trap value the exact moment it appears on the market.
That is the core of it. And the result of Peter's 10:35 p.m. call really proves the mechanism works.
What did he end up getting?
Peter secured an interest rate of 5.875% on a $300,000 30-year loan. And he specifically noted in his review that another retail loan company was quoting him 6.25% with the exact same points and fees.
Wow. The math on that is significant. I mean, a difference of roughly 0.3% on a $300,000 mortgage over 30 years, that translates to tens of thousands of dollars in interest saved.
Easily.
And we actually see this requirement for speed validated in other reviews, too. Armand C. noted that they were able to close their entire loan in just 15 days.
Which is incredibly fast.
Yeah, and Natalie L. closed her home purchase in about 3 weeks.
In the context of California real estate, a 15-day close is a massive tactical advantage.
How so?
When you submit an offer on a highly competitive property, the seller is basically looking for certainty.
They want to know the deal won't fall through.
Exactly. If you bring a pre-approval from a broker who is known to close in 15 days, your offer suddenly looks much safer than a buyer using a massive, sluggish retail bank that might need, 45 to 60 days to navigate their own internal bureaucracy.
Here's where it gets really interesting. Speed and wholesale access will win the immediate deal. They get the client the house.
Yep.
But a perfect 5.0 rating over 114 reviews indicates something else is happening long after the keys are handed over. Reviewers consistently highlight his role as a long-term strategist and educator.
Because the post-transaction relationship is usually where traditional lending models completely disappear.
They ghost you.
Pretty much. Once the loan is funded, the asset is often sold off to a servicer, and the consumer never speaks to their original loan officer ever again.
But looking at the sources, Timothy actively subverts that. Natalie L., the one who closed in 3 weeks, pointed out that Timothy guided them through a customized credit repair plan.
It's rare.
It is. He didn't just pull her FICO score, look at the debt-to-income ratio, and say yes or no. He actively coached them on the mechanics of credit utilization to actually improve their financial standing.
That requires taking on an advisory role, and it extends beyond just credit scores, too. Another reviewer, MEB, praised him for helping navigate the new SB 326 regulations.
Let's clarify what that is, because if you are listening to this in New York or Texas, you probably don't care about a specific California state law.
Fair point.
SB 326 is a strict regulation requiring mandatory safety inspections for condo building balconies and elevated structures.
And the reason a mortgage broker has to care about an engineering safety law is that lenders will absolutely refuse to underwrite a loan on a condo if the homeowners association hasn't completed those specific inspections.
Oh, so it can just kill the deal.
It can instantly derail a real estate transaction. By educating the client on SB 326, he's preemptively steering them away from properties that look great on paper but are completely unfundable in reality.
So it's pure risk management. And he also teaches clients how to look forward. Reviewer Jenny L. wrote this incredibly telling line. She appreciated how he shared his expertise so they could become future landlords.
I love that.
He's planting the seed for wealth generation right there.
If we connect this to the bigger picture, this educational approach fundamentally shifts the entire business dynamic. He is transitioning from a transactional vendor to a lifelong financial advisor.
Right.
And he heavily leverages technology to maintain that position.
That stood out to me as well. Both Arnold J. and MEB specifically praised an automated mortgage monitoring system that Timothy sets up for his clients after they close.
It's so smart.
It actively watches the bond market we talked about earlier. And the exact second interest rates drop to a point where a refinance makes mathematical sense, this system proactively notifies the client.
It is just a brilliant execution of long-term value.
Yeah.
He is essentially doing the financial homework for his clients years after the initial transaction.
Yeah.
Arnold noted that because of this proactive outreach, he completed a refinance that significantly reduced his monthly payments and his overall interest load.
That's amazing.
And Arnold had already used Village Mortgage for the initial purchase and naturally returned for the refinance.
I mean, it creates a completely self-sustaining pipeline of business. If a financial professional randomly reaches out 2 years after you last spoke and says, hey, the market shifted this morning and I can save you $400 a month starting tomorrow, you're going to be a client for life.
Without a doubt.
You're going to refer your friends and your family.
But we do have to look at the mechanics of how he actually serves that lifelong pipeline. Because acting as a strategist for someone who wants to become a future landlord or a real estate investor is only practically possible if you have the specialized tools to support them as their financial lives become more complex.
That is the catch, isn't it? You can't be a long-term strategist for a budding real estate empire if the only tool in your belt is a standard 30-year fixed conventional loan.
No, you'd cap out immediately.
Which brings us to the actual arsenal of products listed on the Village Mortgage website. It is a massive menu. They have conventional and FHA loans, which, are standard.
Right. Everyone has those.
But then they list AT-LOCs, jumbo loans, reverse mortgages, DSCR, fix and flips, non-QM loans, and stated income loans.
Let's break those down because that is a highly specialized, non-traditional toolkit.
Yeah, please do.
A AE-LOC, or home equity line of credit, allows a homeowner to borrow against the equity in their house without touching the incredibly low interest rate they might already have on their primary mortgage.
Which is huge right now.
Exactly. Then jumbo loans are required in expensive markets like California when a home's price exceeds the conforming loan limits set by federal agencies. Reverse mortgages, on the other hand, are a complex tool for seniors aged 62 and older to convert part of their home equity into cash without having to sell the home.
Okay, so those are powerful, but they still feel somewhat traditional. Where it gets complex is the alphabet soup of investor products.
Oh, definitely.
How do these obscure programs like a non-QM loan or a stated income loan actually serve the everyday modern worker we've been talking about?
This raises an important question about how standard banking algorithms view the modern workforce.
Okay.
Traditional lenders operate sort of like a bouncer at an exclusive club with a very strict dress code.
I like that analogy.
And that dress code is a clean, highly predictable W-2 tax form showing a consistent salary. But think about the economy today. You have massive numbers of gig workers, freelancers, independent contractors, and small business owners.
Right. People who might have incredible cash flow, but they write off significant business expenses to legally lower their tax burden.
Exactly the problem. On a standard tax return, a highly successful entrepreneur might show very little net income because of smart tax deductions.
Yeah.
So when the traditional banking algorithm looks at that tax return, it instantly rejects them. The bouncer turns them away. A non-QM loan, which stands for non-qualified mortgage, operates more like a backstage pass. It allows a broker to bypass the strict W-2 requirement and use alternative metrics to prove financial stability.
So how does that actually work in practice? If they aren't looking at the tax return, what are they looking at?
They might look at, say, 12 to 24 months of actual bank statement deposits.
Okay.
If the underwriter can see a consistent flow of gross revenue coming into the business accounts every single month, they can calculate a qualifying income based on that cash flow rather than the final line of a heavily deducted tax return.
That makes so much more sense.
It aligns the lending process with the reality of how the borrower actually lives and works, empowering those California borrowers who don't fit the mold.
It's basically a workaround for the rigid algorithms, and then there are the investor-specific products on his site, like the DSCR loans and the fix and flip programs.
Right, so DSCR stands for Debt Service Coverage Ratio. This is a vital tool for the clients Jenny L. mentioned, the ones learning to be future landlords.
Okay, walk us through it.
When you apply for a standard mortgage, the bank looks at your personal debt-to-income ratio. But with a DSCR loan, the lender looked almost entirely at the investment property itself.
Wait, really? Not your personal income?
Exactly. If the monthly rental income generated by the property is higher than the monthly mortgage payment, taxes, and insurance, the property essentially qualifies itself. The investor's personal income becomes secondary.
That completely changes the scale at which someone can invest. If you have the capital for the down payment, you aren't bottlenecked by your personal W-2 salary when buying your third or fourth rental property.
Add in the fix and flip loans, which are essentially short-term, hard money loans designed to let an investor purchase a distressed property, fund the renovations, and sell it quickly based on the after-repair value, rather than its current dilapidated state.
When you look at the entire operation from top to bottom, it just functions as a complete closed-loop ecosystem.
It really does.
The 100 wholesale lenders give him the inventory and the pricing power. The 24/7 radical availability allows him to capture the volatile bond market pricing the exact second it dips.
Yep.
The educational advisory approach builds trust and navigates complex hurdles like local state regulations. And that massive array of non-QM and investor tools ensures that as a client grows their wealth, they never outgrow his ability to finance their next step. So, what does this all mean?
It highlights a severe complacency in how we handle our finances. Because the industry standard for mortgages, insurance, and banking is so fraught with friction and delay, consumers have just been conditioned to accept poor service as a mandatory cost of doing business.
We just assume that feeling like a cog in a massive machine is how finance works.
But the Village Mortgage data proves that this friction is not mandatory. It is a choice made by institutions that prioritize their own operational convenience over the consumer's experience.
Exactly. You deserve a financial professional who aggressively chops the wholesale market on your behalf. You deserve someone who leverages technology and availability to move at the speed the actual market demands, rather than the speed of a bank manager's lunch break.
Well said.
And most importantly, you deserve an educator who brings a comprehensive toolkit to the table, someone who views your first home purchase not as the finish line of a transaction, but as the baseline for a decades-long financial strategy.
Because when a business aligns structural advantages with genuine advisory execution, a flawless reputation isn't just an accident. It is the natural byproduct of the system.
Which leaves us with a provocative final thought for you to chew on today. We've spent this time breaking down how a single mortgage broker in California can build an anomaly of a business simply by treating a loan as a long-term strategic relationship rather than a one-off retail transaction. So look at the rest of your financial life. Think about your daily banking, your property insurance, your retirement accounts, or even your tax planning. In what other areas of your world are you currently settling for rigid transactional service because you assumed you had no other choice?
Where are you accepting the friction when what you really should be demanding is a strategic partner?
Exactly. Taking an inventory of those relationships might be the most profitable thing you do this year.
I couldn't agree more.
Stop letting the algorithm dictate your options. Demand the backstage pass. Thanks for joining us on this deep dive. We'll see you next time.